Hi, it's Paddy Hirsch at Marketplace. Stock buybacks are all about supply and demand. And to illustrate this, I want to use the example of my handbag company, Padbag. Now, I've recently released a limited edition line of 1,000 bags that I'm charging just $5,000 each for. Okay, it's an absolute bargain, let me tell you, because this P here is made of solid gold. Anyway, there's a competitor who's come into the market and he's selling something very similar. And of course, that's taking demand away from my bags and putting pressure on the price. So I decided to deal with this by going into the market and buying some of my own bags back. I actually go into a bunch of the stores and I buy 200 of my own bags right off the shelf. What I'm hoping to do is to increase demand for the bags that are still out there in the market, and that should therefore allow me to keep on charging exorbitant amounts of money for my product. And that's exactly what companies do when they buy back stock. They go into the market, they buy back their own stock, hoping that there's the demand that's out there for the existing shares or the remaining shares will prop up the price. And of course, reinforce in people's minds the idea that the shares should be trading at that level. Now, if a company decides to do that, it can use one of two options. It can either use a tender offer, which is where it goes out to shareholders and says, look, we'll take a certain number of your shares for a certain price within a certain window. Or it can use the open market. Just like me going into the stores and buying off the shelves, companies can just go straight into the market and buy off the market just like everybody else, just buy from brokers or traders or whoever. Now, whichever the company decides to do, this is going to take a lot of money, right? This is an expensive business doing these stock buybacks. And that's why sometimes buybacks can be very controversial, because a lot of people say that stock buybacks are a waste of money. Companies should be using their excess cash to grow, to buy other companies or to expand into other areas, not just prop up their stock price. And forget about those companies that actually go out and borrow money in order to do stock buybacks and prop up the price. I mean, that's the kind of thing that can end up with horrible consequences and leave everybody very badly needing a drink.